Let's go.
Welcome, everyone, to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. This is Ryan Nauman, and I'm the market strategist here at Zephyr. Fiscal and monetary policy uncertainty and some softening economic data has resulted in a wild ride for bond yields, credit spreads, and interest rates this year. While some say there are cracks forming in credit, others say credit presents a good opportunity still. I am very excited about our next guest, as it's going to be a great conversation, who is going to come on and share some great insights into fixed income markets, are there cracks forming, and where he is finding opportunities. But first, this episode is sponsored by the award-winning Zephyr, which helps investment professionals make more informed investment decisions. I'd like to give a very warm welcome to Eric Lutton. Eric is the Chief Investment Officer of Fixed Income at Sound Income Strategies. Eric, thank you so much for coming on. It's an honor to have you on. Really excited about this conversation. A lot going on in fixed income. So can you please tell us a little bit more about yourself and Sound Income Strategies?
Sure. Thank you for having me, Ryan. Sound Income was years ago. It's probably been about 10 years since our inception. A mutual friend put the principal, David Scranton, who I believe has been on your show before, put us together. And David comes from the insurance side of the business. And so he's dealt with cash flows, fixed income, trying to reach retirees with that. And when we met, I thought I came from the institutional side and also dealing with hedge funds and equities in addition to fixed income. But I thought it was a breath of fresh air to find an advisor that realized how important income was and fixed income. It wasn't just for institutional clients. We hit it off, and they had the paperwork come through, and then I came on board to run the strategies and run the money, and it's worked out pretty well. We start off very small. Now we're just over $4 billion in 10 years. That's all organic growth. Because I think the message is hit pretty clear. But as far as the background of the firm, income's the niche, and we deal with a lot of bonds, preferreds, BDCs and REITs, more cash flow type instruments that we can add depending on the client's needs. But it's really just trying to focus on meeting their retirement goals and their expectations for spending X dollars per month or quarter without having to worry about principal.
Yeah, that's fantastic, Eric. And yes, I'd have to agree. You guys have done a fantastic job in your growth in 10 years. Just you and David. David's fantastic. Had some great conversations. You guys have built a fantastic firm there. And it's interesting with income. I often find whether you're talking about dividend income or fixed income, and sometimes when growth and equities are shooting to the moon, people forget about income. But what's interesting now, whether it's on the equity side, dividends aren't like your father's dividends from 20 years ago. There's a lot of tech companies that produce a pretty decent dividend now. So income isn't just for value, real estate, utilities. Income you can get in other fun and sexier places.
Well, you're right. A lot of those tech companies have grown over the years and have not, I wouldn't necessarily call them cash cows, but they've been able to produce the old, what we'd call value blue chip stocks, who are like, our growth bubbles are coming down. Therefore, let's pay out some of these in dividends because we're not quite sure what to do with the money and we want to stay in our niche. A lot of these tech companies now are at that stage where they've produced enough cash. They're like, there's only so many areas where we can employ. It's better to start giving back some of this to shareholders, which I think is a bright move.
Yeah, fantastic. Let's start with the macro environment. A lot to talk. We could have a whole discussion, a whole episode just on the macro environment. Cracks have started to form in the labor market, participation rate, the number of job openings, jolts. Well, while inflation has remained stubborn, it's come down, but now it's kind of stuck here in this little range. What's your take on the labor market and inflation?
Yeah. As we look back, initial volatility in yields pushed the 10-year U.S. Treasury up to about 4.5%, if you remember, at the beginning of the third quarter, and along with bond spreads, which also spiked up. This was due to elevated inflation expectations. And at the time, non-farm payroll numbers hadn't been adjusted, and markets were under the impression that the labor market was fairly strong. Therefore, there wasn't much of a reason for the Fed to cut rates. But even the Fed statements, I think it was back in July, showed that they believed, with the July release, they showed that They believe the job market, unemployment rate
Hmm.
showed strength, the labor market showed strength,
Yeah.
but that settlement quickly changed the first week in September as the August numbers were re-released or released at, I think it was 22,000 jobs is what was created versus an
Yeah.
expectations of like 75,000. And to make matters even worse, I think it was on the 9th where the preliminary revisions came and we lost like over 900,000 jobs from the original
Yep.
Q1 numbers. And that kind of painted, as you spoke about, it painted the labor market, put it in a lot of trouble. It didn't look good. Market sold off. And we have to remember going back last year, 2023 and 2024 and 2023, before it, 23, we produced like 3 million jobs, 2.2 million in 24. And we're, for the first time since I think like the 60s, we're expecting 2025 to be much, much lower. I think they said done immigrants, you have to understand immigrants make up about 20% of the workforce. And we're only producing about 500 to 600,000 jobs this year so far. We'll see what the number comes up to, but that 20% is coming down. And we have to remember that reduced immigration, whether it's legal or illegal, obviously reduces the supply of labor, and that in turn slows economic growth and job creations. Like you said, it's coming down, and I don't think we're out of the woods
Yeah.
just yet. And with the Fed's dual mandates, Powell had to quickly pivot at the Jackson Hole symposium due to the weak jobs numbers. And that's when the Fed cut their rates back down to 4 by 4.25. So I believe the weaker labor numbers are as much related to the shift in lower immigration and immigration policy as it really is an economic slowdown.
Yeah.
And when you consider that employment rate we're still at what,
Yep.
4.3%? And the labor force participation rate still 62 and a half, somewhere around there. So it's not all necessarily due to weak economic factors. Another factor that keeps it strong is given the upper middle class and wealthy households, along with the government and business constantly spending, we're going to need to see a big crack in the equity markets and a big dip before we start to see wealthier households curb their spending. Otherwise, to bring up your point earlier about inflation, I think it's going to be sticky going forward. I don't see it really coming down too much.
Yeah. I agree. I think this last little leg to the Fed's 2% or average 2% rate is going to be a hard little stretch to get to and going to be
Yeah, I
remains.
think those days are over with just super cheap labor from China, keeping those rates down. I think we've gone through that cycle. I don't think we're going to see 2% anytime soon.
Yeah, I agree. And you brought up some fantastic points about the labor market and just some uncertainties, what immigration is impacting it to. So it's going to be an interesting few months here to see how it plays out in upcoming data. And you mentioned the Fed's dual mandate. Obviously, we talk a lot about the labor market and inflation. Are there other parts of the economy that you're watching outside of jobs and inflation that might paint the economy in a better light, or just maybe people aren't looking at enough?
Yeah, there's always, as you say, there's always other things we have to look at. Given Trump's tweets about a renewed U.S. China tariff war, that caused a material sell off last week, and that wasn't much fun.
Yeah,
Some large tech names have also warned that increasing AI cost and also some that's spooking markets as well. And some of the big tech firms, if their AI costs are going to increase, now obviously that means what's going to happen in net margins, how much are they going to get squeezed? What's the earnings per share guidance going to be going forward? With October's renewed tariff fear coming on from some tweets, and lower potential revisions of some of the big companies, there's always something to think about. Not to mention, I think it was just a few minutes ago, a couple of regional banks just disclosed problems with loans. There's allegations of some possible fraud. Markets don't like to see events like this. So we're always looking beyond the macro inflation jobs numbers. There's always other things we've got to take a look at. Another
yeah,
point to bring up too was the current government shutdown. While irritating for some people and loss of a paycheck for others, it hasn't affected financial markets too much as yet. We could see as much as I saw a quarter point downward revision in GDP numbers for every full month the
yeah,
shutdown lasts, at least according to some economists anyway. Even though a quarter point is probably a little aggressive when they talk about it, but considering past government shutdowns, workers get back pay at least for the time missed. So it might not be
yeah,
too big a deal, unless, of course, this administration decides to permanently dismiss workers. And then it can
yeah,
possibly see a quarter point negative movement in GDP numbers. There's always different factors
yeah.
to look at. We have to consider.
Eric, that's a good point too. And you think about the time where I can't believe I'm about to say this, but we're getting into the holiday shopping season too, right?
Yeah.
All those government workers who are unemployed, yes, they might get back pay, but the longer they're unemployed, how does that going to impact spending for the holidays, which we know is a huge contributor to overall GDP.
We'll see. You'll see some tightens of belt, but then again, you might see credit card numbers spike up for
Oh
a
yeah,
quarter. That sometimes that plays a factor, but hopefully the
yeah,
shutdown won't last too long and people get back to work because it's no one wants to deal with that.
yeah. Speaking of the fiscal side of it, and it goes ebbs and flows about the fiscal deficit, right? The budget deficit. And I feel as if sometimes people don't make enough about it, especially fixed income. Some don't. What's your view on the fiscal deficit? Is it something that really we should be focusing on and it might drive yields higher?
Yeah, it's something we always look at, and we could have a whole show talking about the extra 2 trillion coming down the pipe each year and deficit spending, and our stable coin is going to be able to suck up that supply, and that's a whole other, ball of wax. But if we look at interest rates, like the Fed and the Canadian Bank of Canada, Australian, New Zealand banks, they've been lower. They're in a lowering cycle. Europe and the Bank of England, their rates
Yeah.
are steady for now. This is going to prove actually put in some reinflation into an already
Yeah.
mature and late stage expansion, in my opinion.
Yeah.
So we probably won't see too much subside anytime soon. With asset prices are going to bleed up, chances are, in the equity market as well. One indicator that I think that could help when we look at inflation or core CPI is going to be housing or shelter numbers. That's about 40% of course core CPI. And I think the new lease rates, rental rates, that decline will help offset some other inflation, whether it be in food, and luckily energy is down right now. Hopefully there'll be some ways to counteract that inflation. We
Yeah.
won't see it spike up well above 3, but we'll see.
Yeah, very good point. And I'm glad we're not having that conversation today about stable coins and I'm not smart enough. We'll have to have somebody else come and discuss that with you. I'm not smart enough to figure that out. No. We've already talked a little bit about the Fed. Hard to talk fixed income without talking about the Fed. They recently cut rates by 25 basis points to that 4.25 range. However, I think what's maybe even more important is there's been a lot of differing opinions within the Fed and Fed officials dissenting and stuff like that. What is your take on the Fed moving forward?
Well, like I said, I think the Fed's under a lot of pressure to cut rates. And until the labor numbers cracked, there really wasn't an official good reason to cut rates. Like I
Mhm.
said, unemployment was still 4.3, labor force participation strong. So they needed some numbers, and those job revision numbers were pretty bad. So that gave them the first push. Now they're going to be data dependent and look at what numbers come out between now and then. Like I said, if part of that labor, if we're only creating 20,000, 30,000 new jobs a month, and who knows what the average will end up being for the year, that might be the new normal for a while, given how many how much is migration slowed down, immigrant jobs slowed down, how much is, whether it's illegal or illegal, that's hit a brick wall, and a lot of people have been deported already. So that's going to have a factor. So maybe we don't need 100,000 new jobs right now to still be somewhat healthy in our economy. So
Yeah, very good point.
I don't. They're going to be hard pressed to cut a lot more. I think a quarter to a half is already baked in the
Yep.
numbers between now and the end of the year. It's 2026 we're looking at. Again, unless the numbers are really bad or we go into a recession, they're going to be hard pressed to really cut materially from there.
I agree. I agree. For years, really since the 80s, bonds, a lot of bond people, I don't know what you're going to view about this, but I feel as if bonds were really boring then. Really, since the 80s,
Yeah.
interest rates were falling, and that resulted in a historical bull market for bonds. It was great since the 80s. Then all of a sudden, like COVID hit, and then the Fed jacked up rates at the quickest pace in 40 years. A lot of things happened. So boring bonds were no longer boring then. They were pretty exciting. Are bonds boring in your eyes? And if not boring, is that good or bad?
Yeah. To me, bonds have been boring, especially since the great '08 recession, because rates dropped to nothing. So savers, investors had to look other places for income or yield, at least until the last interest rate cycle. The fixed income investors weren't getting paid above the inflation rate to hold bonds. So you might park a little bit of money there, but equities were the main game in town. But honestly, I look at bonds this way. If you want your bond portfolio to be boring. You don't want a bunch of headline risk or volatility in your bond portfolio. If we were picking good credits and solid yields in our portfolios, we shouldn't have a lot of high turnover or any issues to talk about it when it comes to bonds. You want your growth equities to be the exciting thing and move. If I can make 20, 30, 40% a year, that's what you want to talk about at parties. So my view, bonds should be boring, or your bond manager probably is taking on too much risks or not really doing their credit homework.
Yeah, very good point. Those day was 2022 when the egg had its deepest drawdown in history, and it fell nearly 20%. That,
Worst bond market I saw.
yeah,
Yeah.
that's not supposed to happen.
Yeah, it was the worst, like you said, it was the worst market in 4 decades. And I think the worst US Treasury since the US government ever issued treasuries, ever. It was pretty bad. Hopefully, we won't see any of that anytime soon.
And I often say too, those times weren't normal. We're coming out of the pandemic. We had 40-year high inflation, the Fed, we had interest rates that were very low, then they cranked them up. It's just not normal.
Yeah.
So,
They did it fast too. Fastest since 1980.
yes, exactly. Let's talk about real yields. You mentioned it earlier. Real yields continue to be attractive. For once, savers are getting rewarded or getting paid to in real yields. Do you see this continuing, and what does it mean for savers moving forward?
Yeah. With inflation at 2.9%, the 10-year US Treasuries at what, four? No, now because of those banks, now we cracked four, we're at 397. And the triple B investment grade, double B spreads that we're picking up for our clients, basically 175 off to 300 basis points off the treasury curve. I do see overall yields is still attractive for clients. And I believe this will continue for a while. I just don't see rates going back down to what we had, that zero interest rate policy, like we were speaking with cheap labor in China. It means savers actually earn something over and above the inflation rate. Now, whether we're getting paid properly for that risk we're taking on debt markets, that's could be a different story to talk about. But relative to the inflation numbers right now, I think it's all right for savers to pick up bonds here.
Yeah, I agree. I think there's still some opportunities there. Maybe not as attractive as it was earlier this year, but still some very good opportunities there. And speaking of earlier this year, Liberation Day, it's going to go down in the history books, I think, of the Liberation Day. Credit spreads fell and didn't signal much distress in markets following Liberation Day. After those couple days, it was surprising how credit spreads fell so quickly following Liberation Day. However, credit spreads have increased to their highest level since June, while equities continue to climb higher. So there's a little disconnect there. What are your thoughts on credit spreads, and do you think markets have it right?
Yeah, in April, after spiking up, and they spiked up pretty quickly. We've seen investment grade and high yield spreads tighten during the third quarter. With, I believe, investment grade credits were tightened about 9 basis points, which became like almost a 30-year low. So we're like 70 basis points off the treasury curve and investment grade. And high yield tightened by about 23 basis points, or about 260, 270 roughly when it comes to, but when it comes to high yield. But most of that comes in the triple C space. That's what really moves. But double B credits tightened about 2 or 3 basis points. That said, Trump's tweets, what was the last week about China going another 100% increase, that caused an equity market sell-off and spreads to widen again last week. And it's not like credits got a lot riskier overnight. It's just that there was a flight to quality. So U.S. Treasuries rallied a bunch, and corporate bonds didn't really rally that much. Therefore, it made just for a wider spread environment at the time. But yeah, to answer your question, I do think the bond market is correct. They got it right. And the bond market's pretty fairly efficient, more so than I would say probably the equity market.
Yeah. There's a reason why they call it the smart money.
Yeah.
So we talked about the macro environment, uncertainty with the Fed, fiscal policy. What are your primary risks that you're focusing on right now?
We try not to get too caught up in the daily or weekly noise of the markets and try to stick to kind of a longer term outlook. We consider economic cycle, the business cycle, sub-industry cycle, our interest rate outlook. And of course, we go in heavily into company specific risk, looking at the annuals, quarterlies, getting on an earnings call with management. But as long as we're adding quality names and companies to our portfolios, I think we'll perform well versus the benchmarks in our peer group. At least we have so far in the last
Mhm.
or 10-year time frame since inception. There's always going to be, like today, market sold off big, and not big, but we lost all our gains because of these two regional banks.
Yeah.
So there's always going to be something that hits the market.
Yeah. Yeah. You gotta think long term.
Yeah.
And you'll lose way too much sleep if you're looking at markets every day,
Yeah.
every minute.
And if, like I said, if you're looking at good credits, then chances are in a long enough time frame, you're going to be fine. You're going to earn. You're going to beat your benchmarks. So if you're constantly zigging and zagging, especially in fixed income, there's always some slippage when you're buying and selling, and that's what you want to stay away from because that will eat away at that coupon interest.
Yeah. Let's turn it around and finish on the bright side here and talk about
Sure.
some opportunities. I've heard some fixed income managers and talking head, they say focus on income versus duration, especially like you said, maybe the Fed might cut another maybe half a point at most. So maybe there might be a play in duration or income. What's your take, and where do you find is parts of the fixed income market most attractive?
The parts that are the most attractive, we are usually the most risky, and those are the parts we don't get involved with. Like that's going to be distressed debt or private credit, you know. But I would say what's more important, yield or duration? They both have their all else equal. You want that yield, you want that coupon interest coming in. But a good example is what we've had recently with the yield curve inversion, which I believe it flipped positive last
Yep.
year, and the twos tens have gained some traction. But a lot of people were thinking, oh, the Fed's going to start cutting rates. I'm going to lengthen my duration. That's what you heard a lot of
Yep.
places talk about. And I'm like, that's not the way to play. You want to start buying in the short end of the short belly of the curve. The 2 to 7 year really is what's going to, as that curve inverts, you're going to see it steepen real quick because the Fed's lowering rates. You're going to make a nice capital appreciation there. And once that happens, which it has, now you can think about selling those as you're rolling down the yield curve and then going after some of the more yieldy parts of the curve and extending duration. Then a lot of people, they start hitting the accelerator way too early and going out in the long end of the curve looking for that coupon interest or yield. And they, up until a while ago, you really in the long end of the curve actually didn't do anything. It sold off a little bit. And I think people, you're better off packing the short end of the curve until the rate cycle's about done. Then you can start extending duration again. So there's times to look for the yield and the coupon interest. There's other times to make the duration bet.
Yeah. You brought up a good point. And I lied. I thought that was going to be the last topic. One more here, real quick,
Sure, sure.
is we talked about the Fed and you talked about the long end of the curve and not moving a whole lot. Or has Fed lost control of the long end of the curve a little bit, you think?
Yeah, I don't know what they're doing in offshore secret accounts, whether they're buying the long end or not. Usually insurance companies control the long end of the curve because
Okay.
they're doing asset liability matching. And those are usually the big buyers of the curve that control that. The Fed, as we know, that's just the Fed funds rate. That's overnight rate. They're controlling that short end.
Yeah.
Now, granted, in theory, if you control short-term rates, there should be a certain premium
Yep.
for duration or maturity and credit risk. But the Fed really, I think the insurance companies have a lot more control over the long end of the curve than the Fed does,
Interesting.
unless they're doing something we're not privy to those
Yeah.
conversations.
Yeah. Which very well could be the case.
Yeah.
Yeah. Eric, thank you so much for coming on the show. Fantastic conversation. I love getting deep into the fixed income weeds. Really fascinating. I personally think for years it was boring, but now it's fixed income. I think it's a fun conversation and good,
Yeah.
exciting conversation. And but I do agree with you. It should be boring. It should be boring.
Yeah.
Yes. So thank you. It's been an honor. Where can our audience get more information about sound income strategies?
Sure. They can go to our website, soundincomestrategies.com. We're headquartered in Fort Lauderdale, Florida. They can give us a call, shoot us an email, and we have advisors across the country.
Yeah.
But yeah,
Fantastic, Eric. Thank you so much. And thank you, everyone,
thank
for
you for having me.
listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other episodes on the Zephyr YouTube channel and on Spotify. Please remember to like and subscribe to those channels and give us a follow on LinkedIn. Thank you very much and have a great rest of your week.